All right, let's talk about investing. For years, we've been told it's this super complex world of numbers and markets. But what if I told you the math part is actually kind of solved, and that the real, wild, unpredictable part is us?
So let's cut through all the noise for a second. Forget the scary headlines and the complicated charts. What is the single greatest threat to your money? Is it a market crash, a recession, maybe inflation?
Nope. It's the person staring right back at you in the mirror. That's right. The biggest risk to your portfolio isn't out there somewhere. It's sitting right between your ears. Today, we're going to unpack exactly why that is and, more importantly, what you can do about it.
I mean, the golden rule of investing couldn't be simpler, right? Buy low, sell high. So why on earth do so many of us end up doing the exact opposite? Well, it's because our logical brain gets completely hijacked by two of the most powerful emotions we have: pure fear when the market's tanking and intense greed when things are going crazy. It's what makes us panic sell at the bottom and pile in at the very top.
So why are we like this? Why do we keep making the same mistakes? Well, the answer is buried deep in our own evolution. Let's take a look at the hardware we're all working with.
See, your brain is an absolute masterpiece of survival. It's been fine-tuned over millions of years to keep you alive in a really dangerous world. It's designed for quick, snap judgments, which is fantastic if you're trying to escape a saber-toothed tiger, but it's a total disaster in modern financial markets. We're basically using a caveman survival kit for a job it was never, ever designed to do.
And this quote from neurologist and investor Dr. William Bernstein just nails it. He said, "Learn to control your limbic system or else you will die poor." That limbic system, that's the ancient emotional fight or flight part of your brain. And if that's the part making your financial decisions, well, your long-term goals are in some serious trouble.
You know, there's a whole field of study dedicated to this exact problem. It's called behavioral finance. And it starts with a really simple but revolutionary idea. Investors are human. We're not the perfectly rational robots that old-school economic theories thought we were. We have biases, we struggle with self-control, and our psychology messes with our money in a big way.
So let's meet a few of these specific mental glitches, the little gremlins in our brains that constantly lead us astray as investors.
First up, we've got loss aversion. This is all about the weird math of our feelings. Psychologically, the pain of losing $100 hurts about twice as much as the pleasure you get from finding $100. Think about that for a second. It means that when the market goes down, the pain we feel is completely out of proportion, which just primes us to panic and do something dumb.
And this emotional quirk leads directly to two of the most common mistakes in the book. First, we hold on to our losing investments for way too long, just hoping they'll crawl back because we can't stand the pain of admitting we made a mistake. And on the flip side, we sell our winners way too early just to lock in that little hit of pleasure and avoid the potential pain of watching it disappear.
Next, there's the sunk cost fallacy. This is our stubborn, almost irrational inability to just walk away. It's that feeling that because we've already poured so much time or money or effort into something, we have to see it through, even when all the evidence is screaming at us to cut our losses and run. It's like being emotionally handcuffed to a past decision.
Here's exactly how it plays out. Let's say a stock you own is down 50%. Your sunk cost brain, totally fixated on the price you paid, is whispering, "I can't sell now. I've just got to wait till I get my money back." But that original price is totally irrelevant now. Your rational brain asks the only question that actually matters. Forgetting the past, if I had this money in cash right now, would I buy this stock at today's price? If the answer is no, it's time to move.
Then we have good old confirmation bias. This is our natural tendency to live in our own happy little echo chamber. Once we've decided to buy something, we go out and look for news and opinions that tell us how brilliant we are. And we conveniently ignore or dismiss anything that suggests we might have been wrong. We're not really doing research, we're just looking for a pat on the back.
And finally, there's herding. Back on the savannah, if you saw the whole herd suddenly start running, you didn't stop and ask why. You just ran with them. Staying with the group meant survival, and that instinct is still wired into us. So when the market crowd starts to panic and sell, our gut screams, "Go with them, it's safer." But in investing, the herd is almost always stampeding in the wrong direction, buying at the peak of euphoria and selling at the absolute bottom of a panic.
Okay, so if our brains are basically hardwired to fail at this, how does anyone ever succeed? Well, it all starts by changing the game you're trying to play.
The legendary investor Charles Ellis came up with this brilliant idea. For most of us, for the amateurs, investing is what he called a loser's game. Now, what does that mean?
It means the winner isn't the person who makes the most genius moves. The winner is simply the person who makes the fewest big, stupid mistakes.
Ellis used this fantastic tennis analogy to explain it. Professional tennis is a winner's game. Pros like Djokovic or Williams win by hitting incredible, untouchable shots, aces, and powerful winners. But amateur tennis? That's a loser's game. You don't win by hitting amazing shots. You win by just consistently getting the ball back over the net and letting your opponent make the mistakes, hitting it into the net or out of bounds. Most of us try to invest like pros, looking for that killer shot. But we actually win by playing like smart amateurs, just avoiding the big, self-inflicted errors.
And just how hard is it to play that winner's game of picking the next big stock? Well, get this. One massive study found that over the long haul, just 2% of all stocks were responsible for all of the stock market's net gains. 2%. The odds of you consistently finding those few needles in a giant haystack, they're not good.
Okay, you might be thinking, but what about the pros, the people paid millions to do this? Well, think again. Over a 10-year stretch, more than 90% of professional fund managers failed to beat a simple, boring, low-cost index fund. They're playing the winner's game every single day, and most of them are losing.
So, if our goal is to win the loser's game by protecting ourselves from our own worst instincts, what are the actual tools we need to get the job done?
First, you got to build a solid defense, and that means real diversification. But you have to avoid the common traps. It's not about owning 100 different funds that are all secretly holding the exact same tech stocks. And it's not about just buying one good stock and calling it a day. Real diversification means owning different types of things: US stocks, international stocks, bonds, things that don't all go up and down at the same time. And then you have to check in and make sure it stays that way.
Next up, focus on the things you can actually control. You can't control what the market does tomorrow, but you can absolutely control what you pay in fees. And the effect of high fees over time is nothing short of devastating. A tiny-sounding 1 or 1.5% fee doesn't sound like much, but over decades, it can eat up a massive chunk of your potential wealth. Keeping your costs rock bottom is one of the easiest wins you can get.
So here it is, your 4-step action plan to win the loser's game. Number 1, automate everything. Set up automatic contributions so your emotional or rational brain isn't involved in the day-to-day decisions. 2, diversify broadly. Like the great Jack Bogle said, don't look for the needle in the haystack, just buy the whole haystack. 3, obsess over minimizing costs and taxes. And finally, number 4, and this is the hardest one, stay the course. Have the discipline to trust your plan and let it work, even when it feels scary.
You see, the great paradox of investing is that success often comes not from all the brilliant things you do, but from all the dumb things you don't do. It's all about building a system that protects you from yourself. So now that you know the rules of the game, the only question left is, are you playing to win?